Subcommittee will come to order. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. We may have to do that because votes are expected shortly. Without objection, members of the full committee, not on this subcommittee, are authorized to participate in today's hearings. This hearing is entitled State of Emergency, Examining the Impact of Growing Wildfire Risk on the Insurance Market. I now recognize myself for 4 minutes. The National Interagency Fire Center indicates that 5 large new fires were reported, one in Kansas, next door to my state of Missouri, Montana, Oklahoma, the home of the ranking member, Texas, and Washington. Currently, 97 active large fires and complexes across the country have already burned more than 900,000 acres in 8 states. In response, more than 11,000 wildland firefighter and support personnel are assigned to respond to these wildfire incidents across the country. Americans today are fighting to save their families, homes, businesses, and communities from fire. And make no mistake, the threat of wildfire is growing. Between 1980 and 2022, 20 wildfire billion-dollar disaster events affected the United States. 16 of these incidents have occurred in 2000. Most recently, the 2021 Dixie Fire consumed over 960,000 acres, making it the second largest wildfire on record in California, while also destroying more than 1,000 structures. In Colorado, the December 2021 Marshall Fire in Boulder County was the most destructive on record in the state's history. We find ourselves in what some are calling an era of the mega fire. Extraordinary fires in terms of size, in terms of intensity, and in terms of cost to taxpayers and private industry. These mega fires aflame everyone and everything in their path, but they still disproportionately destroy low-income neighborhoods, and they put in jeopardy low-income families and communities who have the least resources to prepare and respond to them. We as a nation have and always will have to manage wildfire risk. Unfortunately, due to climate change, scientists predict more megafires in our future. The central question for this hearing is, how do we coexist with wildfire risk? How do we as a country adapt and become more resilient to the growing wildfire threat? And wherever possible, how do we reduce or avoid risk altogether? And the insurance industry is a piece of this equation. For decades, the insurance sector has continued to underwrite industries and practice that exacerbates climate change and increases the exposure levels for our own investments. That's the problem. But the insurance industry is also a part of the solution. Insurers have a plethora of data that can help public and private stakeholders better understand the climate-related risk and be used in climate-specific stress testing. In my nearly 20 years in Congress, I've seen these issues with flood insurance and other climate-related perils. My fear is that the wildlife crisis becomes a systemic issue, one where the temporary solutions put forward by state regulators collapse under increased risk. Insurance is primarily a state issue, and states across this nation are grappling with the growing wildfire risk. During this hearing, we want to know how regulators and the insurance sector are managing this risk in the short term, and if the long-term solution proposed are viable solutions. We want to know what the insurers are doing to make sure that American families and communities can recover once disaster strikes. And so I look forward to this hearing and the recommendations. I now recognize the ranking member of the subcommittee, Mr. Hill, for 5 minutes for an opening statement.
Well, thank you, Chairman. I appreciate the chance to be with you today, always, and very interested in this topic. It may be the first time the Financial Services Committee has ever held a hearing on the threat of wildfires and the role of insurance since this committee became the Committee on Financial Services in the 106th Congress. Wildfires are, of course, a real challenge and a severe problem, particularly in some regions of the country, and certainly worth the time for us to explore and discuss what we're doing right and what we're doing wrong in various aspects of public policy in order for our citizens to better prepare for coping with and dealing with this devastating risk. Statistics show that over the last 20 years, an average of about 7 million acres per year across the country have been burned by wildfire. Over the decades, that varies with rainfall, obviously. And for example, in Arkansas, after the past 9 years of being extremely wet, we're having our first dry year. And in fact, if you look at that, rainfall, for those concerned about and aware of climate change, rainfall is actually increasing all over the country. We have record rainfall now compared to the period 1958 to 1998 in my home state. An estimated 4.5 million properties are at high or extreme risk from wildfires, and nearly half of those, over 2 million, are from the state of California, which has 3 times as many to the second most risky state, Texas. The chair said that states bear the brunt and state policy bears the responsibility for insurance. And while California in many ways, in my view, represents the absolute worst of the problem, the local market for insurance, which we'll get into later, not impressive. And wildfires are by no means just concentrated, though, out west. As my colleague from our Arkansas delegation, Bruce Westerman, who's the ranking member on the House Committee on Natural Resources and the only licensed forester in Congress, has said, we have quite literally loved our trees to death through mismanagement that has led to insect infestation, overstocked stands, and dead and decaying trees. And this is a particular crisis in the Rocky Mountains and the coastal West. The solution is, not unsurprisingly, the adoption of sound forest management policies. Plus, in addition to that better land management, public land management, better local land use decisions, responsible development would all reduce risk, predictably reduce risk. But prevention is only half of the battle, and that's why we're here today. We also need to make sure that we're making smart financial decisions so that individuals and business can across the country access and have affordable insurance they need to protect their property. Insurance is just a tool, and one that works only when the fundamental principles of risk pricing and competitive enterprise are followed. In the most basic terms, you want lower rates? How about creating an environment of lower risk? And as we've witnessed in energy policy and water policy, forest management practices, and now in insurance, California is no place to emulate, and in fact, a cautionary tale of what not to do. Instead of allowing premiums to correspond to risk, California has layered on price controls on top of mandatory coverage, on top of automatic renewals. All that means that it's money losing and it doesn't add up. And who's hurt? People who are insured. For a state that claims, as a bold leader on climate change, its regulations literally prevent insurers and policyholders from taking the future risks of rising temperatures into account. And in fact, too many homeowners are left in the lurch, needing coverage that isn't available in amounts or at prices they want. And outside insurers know better than to invest in California, a market built on unfair rules. That's a painful and costly exercise, and one that we will explore today. But Mr. Chairman, better insurance markets occur when you send smart pricing signals to poorly considered municipal and county zoning, land use, and development practices, which is no doubt a big part of why insured losses in California are larger than they should be. I thank my friend and I yield back.
The gentleman yields back. Witnesses who are here today, we welcome you, and those of you who are with us virtually, we appreciate you giving us your time today. First, we have Matthew Auer, who is the Dean of the School of Public and International Affairs at the SEC School of Georgia. Next, we have Amy Bach, who is the Executive Director at United Policyholder, and we have Mr. Ricardo Lara, who is the California Insurance Commissioners, and Wright, who is the President and CEO of the Insurance Institute for Business and Home Safety. And finally, we have Rex Frazier, who is the President of the Personal Insurance Federation of California. Witnesses are reminded that their oral testimony will be limited to 5 minutes. You should be able to see a timer that will indicate how much time you have left. I would ask that you be mindful of the timer so that we can be respectful of both witnesses and committee members. Without objection, your written statement will be made a part of the record. We're going to have some little technical issues probably because many of you are not going to be able to see the timer. So I will unfortunately have to tap on the desk so that you will be given a caution that the time is almost out. Mr. Auer, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Good morning, Chairman Cleaver, Ranking Member Hill, and members of the subcommittee. I'm Matthew Auer, Dean of the School of Public and International Affairs at the University of Georgia School of Public and International Affairs. I began a career in forestry and environmental policy in the 1990s. Back then, policy experts predicted that climate change would challenge how insurance companies typically model and price risk when they underwrite insurance policies. Ample, reliable data tell us now that climate change, including increased heat, extended drought, and lower humidity in western states, are major drivers of wildfire. As predicted, these environmental changes are playing havoc with insurance markets, and this affects everyday policyholders, including lower-income homeowners. Graduate student Benjamin Hexamer and I wanted to gain a clearer sense of which homeowners are at particular risk in the most wildfire-prone states. We found that 60% of counties with moderate to high wildfire risk in the most wildfire-prone states also have a poverty rate exceeding the national poverty rate. Hence, the majority of homes in the most at-risk counties in western states and in Florida are in areas with comparatively higher poverty rates. Increasingly, insurance companies as well as state and local authorities require homeowners to adopt fire safety measures. For some homeowners, this is a condition for a new policy or for renewal of coverage. This can pose hardships for lower-income homeowners. If an insurance company were to require a policyholder to implement wildfire safety measures, including, for example, removal of branches or of whole trees overhanging a roof, those costs can add up. Consider that a premium for $250,000 worth of dwelling coverage in New Mexico is around $1,900. That represents over 6% of median household income in a county like Mora, New Mexico. Mora was one of the counties hit by this year's Hermit's Peak Calf Canyon fire, the largest wildfire ever recorded in New Mexico. Federal assistance will continue to loom large for the most at-risk communities. Consider that the state of California is currently distributing FEMA funds in a pilot project called the California Wildfire Mitigation Program. Communities selected for assistance have higher concentrations of people over the age of 65, residents with disabilities, people living in poverty, and populations with limited English or lack of access to a car. This is a cost-share program. FEMA pays up to 75% of the cost for eligible mitigation projects. The state has made a 25% match at the local level. In some parts of the country, the match is not always possible, and communities, including tribal communities, frequently lack adequate staffing to implement the grant. These problems could be alleviated by more consultation between FEMA and states about which communities to serve and the provision of adequate funds to assure staff hiring and training. FEMA-supported programs like the California Wildfire Mitigation Program and Safer from Wildfires, an initiative spearheaded by California's Insurance Commissioner Ricardo Lara, are designed not only to help homeowners are designed not only to directly help homeowners make their homes safer, but also to inspire insurance companies to re-enter the market. These programs could shift the insurance industry's thinking, transforming risk into opportunity. Nevertheless, even as insurance and reinsurance companies become more proficient at estimating risk, the advantages will be less profound for lower income homeowners and renters, particularly if better risk forecasting means higher premiums and lower coverage limits. When it comes to protecting the most vulnerable communities in harm's way, present and future funds authorized by Congress are essential. Indeed, Congress has made programs like the California Wildfire Mitigation Program possible. All the relevant trends indicate that today's pilot programs to harden homes and create defensible space, supported by federal agencies, will need to evolve into longer-term sustained programs that help underserved communities with fire safety measures in multiple states. I wish to thank the committee for their attention to this important matter and for inviting me to today's hearing.
Thank you very much. And now, our next witness is Mr. Bach. You are now recognized for 5 minutes to give us an oral presentation.
Good morning, Chairman Cleaver, Vice Chair Hill, and subcommittee members. Thank you so much for the opportunity to address the subcommittee on a matter of national importance. I represent an organization, a 501c3 based in California, that informs and helps consumers throughout the country. For over 30 years, we've been working system work for the consumers who pay premiums and deserve fair treatment and the financial safety nets they've paid for. We have extensive experience with wildfires and insurance markets in California, New Mexico, Texas, Washington, Oregon, Colorado, and Arizona. You've got the right people in the room here. My organization has been working very closely with 4 of the witnesses here. Rex Frazier has been speaking on behalf of the insurance industry's perspective on these issues for many years. And then, of course, Ricardo, Lara, a very strong leader and a very, very good partner, as has Wright and his organization with the research and the work they're doing. So we've all locked arms to really tackle the situation that's before us today. So in recent years, my organization has had to shift our focus in wildfire-prone areas from educating consumers about not just shopping for the cheapest policy, but actually buying the coverage that's going to really be there for them. We've had to shift from that to helping people find any option. And in many counties throughout California and increasingly in Colorado and also Oregon and Washington, consumers are now having choices, no option for insuring their homes and small businesses other than limited and expensive protection through the California FAIR Plan or residual markets in those other states. So just as insurers have dramatically reduced the number of homes they're willing to voluntarily cover in California, private market options in these other states appear to be shrinking. But with our hardworking partners, the commissioners of both California and Colorado, we're doing everything we can to fix the situation. As Professor Auer noted, this is a long-range game here. This is not a short-term. My organization is doing, through a wildfire risk reduction and asset protection work stream, we have, for the last 2 years, been having monthly meetings with people from all over the country and the state that are working in this space to promote home hardening, defensible space, and community-based programs to help people limb trees, change out their roofs, take away fire hazards around their homes, etc. And we're making a lot of progress. This year saw very significant progress with the IBHS putting out their standards, the Safer from Wildfire initiative putting out their standards, and now we're all on the same page to address what Rex had flagged years ago, which is a skepticism on the insurance industry's part that you can actually move the needle. But we can move the needle. We can reduce wildfire risk, and we're doing it. There's a lot of really good work going on. Now, my written testimony goes into the details of how this all came about. And it does relate to a combination of unfortunate circumstances. It's not just one thing. which is why we need not just one solution, right? It did start somewhat with the tree mortality crisis. But again, when you look at how insurance companies make decisions and you look at what's happened in Florida, it's really, I understand concerns about regulation, but it's really not that. You ask people in California if they think there's price controls in place and they'll say, what are you talking about? I'm getting hit with $9,000 a year premium notices. So it's really more, it's deeper. Insurance companies are highly sophisticated professional gamblers. They will take risks in return for money, but only to a degree. So obviously climate change has caused a lot of concern. And that concern is being exacerbated by all the tools that insurers are now using, risk scoring tools and analytics. And just in conclusion, what do we want to see here? More funding and technical assistance for home hardening and defensible space. We need insurers to reward and incentivize risk reduction through renewal rewards and discounts to those who've reduced risk. We need strengthened, well-run insurers of last resort. We need assistance to residual market property insurance programs, similar to what the Florida Hurricane Cat Fund is doing in Florida to try to restabilize that market. I thank you so much for your time and attention, and I will conclude now.
Well, we thank you very much for your testimony, Ms. Bach. Mr. Lara, you're now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you. Good morning, Subcommittee Chairman Cleaver, Ranking Member Hill, esteemed members of the subcommittee, and thank you for having me virtually speak to you all today. I also want to personally thank Committee Chairwoman Waters for her invitation for me to be part of this hearing, and for the overall attention given to this important issue of insurance availability, reliability due to continued climate intensified wildfires. As the elected insurance commissioner of the nation's largest insurance market, I have taken significant steps to safeguard the availability of insurance for consumers and to maintain a competitive insurance market granted by the California voters in passing Proposition 103 back in 1988. Proposition 103 allows for insurance companies to request rates that are adequate to pay future claims. Again, while giving me as the insurance commissioner the authority to protect consumers from excessive or unfairly discriminatory rates. In December of 2019, I implemented a moratorium law that I proudly authored while I served in the California State Senate that protects wildfire survivors by preventing insurance companies from non-renewing policies for those living adjacent to a declared wildfire emergency for a total of 1 year. Recognizing that it's absolutely critical to give consumers some breathing room after a wildfire disaster. Even if they don't lose their home, they might have lost a neighbor, a friend, and a loved one. And my action also gives insurance companies a chance to assess so that they're not so quick to drop their longtime customers. To date, since 2019, I have protected more than 4 million residential policies from non-renewal by their insurance company. For years, California and other like-minded states have warned repeatedly to prepare for the impact that climate change is having on risk and our ability to prepare for it. At the National Association of Insurance Commissioners, I co-chair its Climate and Resiliency Task Force with my fellow insurance regulator from Florida. Wildfires, wildfire smoke, flooding, and heat waves do not respect state borders. So we have to work together as a state-based regulators of insurance through the NICC. I'm also proud to be creating a historic sustainable insurance roadmap with the United Nations Principle for Sustainable Insurance Initiative, which will outline key actions that regulators and insurance companies need to take to protect consumers and to create a more sustainable insurance market in a time of intensified climate risks. Otherwise, insurance companies that threaten to withdraw from wildfire risk regions of California or any state defy the central purpose for insurance to incentivize home hardening behaviors that will reduce the risk at the end. That is why I created the first in the nation insurance pricing regulation after 3 years of stakeholder engagement and in partnership with California's emergency preparedness agencies that would require all insurance companies to recognize and reward wildfire mitigation efforts made by homeowners and businesses, such as upgraded roofs and windows, defensible space, and living in fire-wise communities. Transparency is another important benefit of my regulation, requiring insurance companies to provide consumers with their property's risk score and give them a right to appeal that score. I also have also advocated for increased state budget funding to help residents and businesses pay for mitigation efforts necessary for them to retain their insurance coverage. I believe funding for pre-disaster mitigation for local communities is critical, and I commend Congress for passing the Inflation Reduction Act earlier this year that includes critical funding for hazardous fuel reduction and community resilience and risk mitigation projects. Every dollar of pre-mitigation saves $5 to $7 in avoided future insurance loss, helping make insurance more available and affordable. And I know you're all familiar with the residential insurer of last resort market, known as the FAIR Plan in California, which will cover you if no insurance company will. Because of an increase of non-renewals in the wildland-urban interface, I have worked to modernize the FAIR Plan by ordering it to provide consumers with increased homeowners and commercial policy coverage limits, as well as offer more comprehensive property coverage. Options to protect what is, for most of us, is our largest financial safeguard, our homes. I'm committed to continue to look at how we give insurance companies tools to better manage risk so that we can maintain competition. However, there must be a firm commitment from the voluntary insurance market to provide and maintain insurance, especially to our most vulnerable. As you know, many rural residents in our states are retirees and on fixed incomes, working people, and those pushed out of the urban core. So again, in sum, Mother Nature is the best advocate we have on climate change. And as one looks to wildfires, I look forward to having this discussion with you. And thank you again for the opportunity to testify. And we'd love to answer your questions when it's appropriate.
Thank you very much, Mr. Lara. Mr. Wright, you're now recognized for 5 minutes to give an oral presentation of your testimony.
Good morning, Chairman Cleaver, Ranking Member Hill, and members of the committee. I do appreciate the opportunity to join you today. Wildfires have always been part of the American landscape. Yet the intensity and frequency of wildfires barging into the lives of our families, well, there's more of that coming. Our work at the Insurance Institute for Business and Home Safety squarely focuses on the collision of wildfire and the built environment, when wildfire attacks and consumes our homes and communities. The compelling video of flames on the nightly news are usually the first wildfire images that come to mind, yet most buildings ignite because they're attacked by embers. Those flying brands, some might be as small as the spark you see when you're roasting a marshmallow. Many are the size of your thumb, and it's common to see the size of the palm of your hand. Yet those embers don't just spray forward a few feet. We regularly see embers lofting for a half mile or more, landing, smoldering, and igniting fire. Wildfire disasters play out differently than floods or wind disasters. Unique to wildfire, the buildings that are hit by embers and ignite become part of the fuel. Instead of dissipating the way you think of floodwaters, once a home ignites, that home becomes an amplifier of the disaster. The inflamed home becomes more fuel that further intensifies the damage across the community. Work on forest management and ignition sources is critical, but we cannot eradicate wildfires from across our landscape. So we need to narrow their path of destruction within our communities. IBHS has pulled the scientific pieces together for home wildfire resilience. The wildfire prepared home needs to address 3 fundamentals. First, the roof, then building features like vents and defensible space. And once all of those are finished, and collectively it is all 3 of those pieces, then you turn to additional measures like fencing, non-combustible siding, enclosed eaves, deck materials, windows, and sheds. The most transformational piece amid all of this, defensible space. We discussed defensible space in bands, the first 5 feet, 5 to 30 feet, and 30 to 100 feet. In a suburban context, the 0 to 5 and 5 to 30 foot, those are the game changers. Consumers need to embrace a new view of home landscaping. Nothing flammable within 5 feet of your structures. No bushes or trees, no plastic bins or cans, no wooden gates. We can make this aesthetically attractive, yet all homeowners who are within the reach of those flying embers need to reimagine the 5 feet closest to their home. Nothing in that space can burn. Nothing in that space can be hospitable to the wildfire embers that can land, smolder, and ignite. Well, we can start at the parcel level of an individual home. The wildfire risk requires us to take actions at the community scale too. Only when entire neighborhoods take these resilient actions through collective action and stronger codes will we be able to truly bend down the risk of wildfire conflagration. Those really catastrophic days when entire neighborhoods fall like dominoes. At the point of new construction, these wildfire mitigation techniques require as little as $3,000. But retrofitting a home can be harder. The cost of rescaping closest to your home varies. Some have little work to do and others have significant changes to make. And the emotional attachment to the look of your home, well, we can all imagine that. It's not just IBHS. Others, like the California Department of Insurance, consumer groups, the insurance industry, and the fire services, are using the same wildfire science in their work. Speaking with a common voice will affect far more change. And none of this is free. We can't in one breath say, the climate is changing and making wildfires worse. And in the next breath say, I want the cost of building and insurance to be cheaper. The changing climate has a cost. For those who can afford to take those actions themselves, we need to nudge them to do so. Others in the panel will speak to the insurance pricing of the risk. However that market plays out, though, the cost of mitigating for wildfire cannot be viewed solely through the lens of insurance premiums. Like energy efficiency tax credits, we need to see financial nudges to homeowners and drive them to fund their own retrofits. And when homeowners cannot afford to take the retrofit action themselves, federal and state grants need to be targeted to help those close the gap. First among those actions, help homeowners change the landscaping closest to their homes to ensure there's not a hospitable area for embers to take hold and ignite. Thank you, Mr. Chairman. I look forward to your questions.
Thank you very much, Mr. Wright. Mr. Frazier, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Good morning, Chairman Cleaver, Ranking Member Hill, and members of the subcommittee. My name is Rex Frazier. I'm the president of the Personal Insurance Federation of California, an association of insurers who provide over 60% of the homeowners insurance coverage in California. Thank you for the opportunity to testify today. Much has changed since 2017, when California experienced over 250 wildfires. That year, there were devastating fires, including the Tubbs Fire, which killed 22 people, destroyed 5% of the city of Santa Rosa's housing stock, and resulted in over $11 billion in insured losses. For 2017 and 2018, insurers made claims payments totaling more than the previous 22 years of underwriting profit. We now have a better understanding of how climate change operates in California. Peak fire season is no longer a predictable part of autumn. Delayed onset of seasonal rains, possibly as late as December, is resulting in longer periods of dry conditions that overlap with the annual Santa Ana, Sundowner, and Diablo wind patterns that can turn small fires into major disasters. Instead of having a month of this dry, windy overlap, we can now face 2 or more months. The insolvency of Merced Property and Casualty Insurance Company, following the Paradise Fire in 2018, has especially driven home the seriousness of the situation. On the positive side, and with only one exception, all major home insurers active in the California marketplace prior to 2017 remain in the market today. They worked with Commissioner Lara and his staff at the Department of Insurance on the difficult balancing act of ensuring financial stability while seeking insurance availability and affordability. Our member companies believe wildfire risk in California is insurable if rates are adequate to match the growing risk. Even when the regular market experiences problems, insurers provide a residual market for all homeowners seeking coverage, called the California Fair Plan, that involves no government funding. But much work remains ahead. The first step is to develop standards for insurers to recognize the benefits of home hardening and defensible space. Of critical importance is the research of the Insurance Institute for Business and Home Safety. Its Wildfire Prepared Home Designation program holds great promise for helping insurers to provide better price signals regarding mitigation. This work is timely because the California Department of Insurance recently issued regulations for for how insurers must communicate with customers about available mitigation discounts. Insurers will be submitting new filings with the department soon. The next step is to advance the science of community-level mitigation. While home hardening and defensible space is important, many wildfires will only be stopped by efforts beyond the individual parcel. So much of wildfire risk relates to bigger considerations, such as the amount of surrounding brush or trees, whether a community is located near slopes, canyons, or wind tunnels, and the amount of access for firefighters to confront a fire. IBHS is researching these dynamics currently, and insurers look forward to studying and incorporating the results. While mitigation is important, there is another issue that, if it is not solved, will limit the California homeowners insurance market. California insurance regulations must be amended to allow insurers to incorporate forward-looking climate science into their rate filings. In California, when an insurer submits a rate filing, it must justify its requested statewide premium for future wildfire losses based upon its average annual wildfire losses over the last 20 years. The request cannot consider the location of the insured properties, their proximity to vegetation, or even if the homes to be insured are hardened. It is a calculation with no sensitivity to changing conditions or evolving knowledge. An insurer is not permitted to seek a higher premium level, even if it would like to go into a higher fire risk area. Under the regulations, that insurer must first sustain high losses and then request permission for a higher statewide premium level. This is not a reasonable expectation. It encourages insurers to withdraw from the highest risk areas. If an insurer has data to support how a particular area is being impacted by fuel loads or climate change, then it should be able to submit a filing to the department, which explains the risk and quantifies the premiums that will be needed to pay the expected losses in the area. There is no other state that requires insurers to look back just 2 decades to justify its requested premium levels intended to fund future wildfire losses. Without updating the rating system, it's difficult to see how
We have obviously a technical problem. Mr. Frazier?
Yes, sir.
I don't want to cheat you out of the last 5 seconds. You had 5 seconds remaining.
Oh, I just said thank you, sir.
All right, thank you. Thank all of you, our witnesses, for coming to this committee today. We appreciate your testimony. The members who are here today, I want you to make sure that everybody understands we may have votes called. So I need everyone to be very crisp in your questioning so that we can not waste any time at all. I want to recognize myself now for 5 minutes and do what I ask members to do. So the first thing is, I think, Mr. Wright, you kind of hit on some issues that are a very deep concern of mine. I have a son who lives out in California, and I go out there and get angry when I see where people build their homes. What actions have insurers taken to respond to the threat of increased economic losses from wildfire disasters, including how insurers are incorporating mitigation and resilience into the business operation?
Thank you, Mr. Chairman. I'll let others speak to the specifics of how they get to pricing, but I can say with absolute confidence that the mitigation actions that we call for, this collective set of make sure you have a good roof, and the good news is 99.2% of Californians already have that, address the vents, and then the defensible space. When the risk has changed, insurers will meet people there. Insurance is supposed to price risk, and to the degree that you can shape that, I think they would meet that.
Thank you. Let's kind of stay on this for a moment, if you will. What actions have insurers taken in terms of the increase in economic losses from wildfire disasters right now?
Again, Mr. Cleaver, I think that others, like Mr. Frazier and others, can get into the specifics of how it is ultimately priced. But I do think that we're seeing people lose their homes, and the cost of rebuilding has continued to go up. And I think that's really the piece that people feel after the event.
Okay, Dr. Auer and Mr. Bach, are there certain parts of the country facing major disruptions to their insurance markets due to wildfire impacts? And what is the outlook for other parts of the country in our future?
Well, if I may, sir, thank you. Just briefly, in the state of Colorado, for example, there is a pilot program that's been underway in Boulder County where there are a number of insurers participating in that program. And if the homeowner has their home hardened with help from the program, the participating insurers will agree to not drop them. They will agree to keep them as a customer. And so we know that can work. But we also know that in Colorado, where you see, it's just like what you saw in Florida. If you see a pattern of a number of years where there's a bad hurricane, that's going to really affect the market, right? We saw it in Florida. We see it in California. We're seeing it in Colorado. We see a series of wildfires. Insurers get the jitters. Understandably, they react. The regulator tries to calm the situation, and the rest of us are doing everything we can to help. You really can't unbuild the homes that have been allowed to be built in these areas. So you just have to work with the built environment as it is. And again, I think the real challenge is getting insurers to get on the train with the rest of us and say, yep, we're not powerless here. There's a lot we can do, and we got to help people do it, and we got to incentivize them. And that's where we really need the insurers to do what they have been doing in wildfire-prone areas, where they reward people for roof tie downs and they reward people for elevating their homes, with preferred pricing.
Yeah, but is education one of the issues? I mean, when I was growing up, you turn on the TV and Smokey the Bear comes up and talks to you. And I haven't seen Smokey in recent years. I don't know if he died or what. But the issue is, for me, really, is that, what can we do in terms of education? 85% of all these fires are a result of human activity, not lightning. And so there's something that we are not doing that we must begin to do. Anyone?
Well, thank you for that good question. The efforts, I think, that Commissioner Lara has initiated with Safer from Wildfires, not only technical issue of home hardening and defensible space at the individual homeowner level, but in addition, and consistent, I think, with some of the testimony that we've heard here, there usually is a community or neighborhood level dimension to these initiatives. And that would be true of, for example, the U.S. Forest Service's Community Wildfire Defense Grant program, some of the FEMA grants that I mentioned before with their hazard mitigation assistance programs generally have a direct educational component. Then moreover, all over the country, there are these community wildfire level plans that have been put in place over the past 10 or 15 years that also focus on education.
Thank you very much. I hate to interrupt you. I now recognize the distinguished gentleman from Arkansas and the ranking member of this committee for 5 minutes. Mr. Hill.
Thank you, Mr. Cleaver. Again, thank you for the panel for bringing your expertise, albeit virtually. We miss seeing you in person. Mr. Wright, has your organization testified before the state legislature in Sacramento or gone to zoning or local planning districts in California and argued against people building houses in places they should not?
We have appeared with the state legislature and at the local level. And while we have not gotten into the specifics of where you choose to site the house, we have aggressively advocated that says, however, wherever you need to build, you must build in a way that can narrow the path of wildfires.
And do you think that local planning and building specs in California reflect your recommendations?
For brand new construction in the highest area of concern, the answer is yes. California leads the way on the building code. We, though, would say they too narrowly apply it, and more homes need to be built to that higher standard to be able to withstand it. One additional piece, defensible space, has to be maintained year after year after year.
Yeah.
So that's not about new construction.
Thank you for that. Commissioner Lara, with a $300 billion surplus in California, what is California doing to help low-income residents on this mitigation piece? Not the insurance piece you're responsible for, but just that county support of mitigation. And do you believe that zoning in California is not done appropriately from a public safety point of view?
Thank you, Mr. Hill, for that question. You know, we've seen the legislature and the governor put a record amount of money into fighting these wildfires, everything from working on creating incentive programs to help people rebuild as quickly as possible. Additionally, providing incentives and funding so that people have the opportunity to mitigate against these wildfires, which is critical. I like to say we should have done this before, but unfortunately, you know, we have the money now to do this.
Okay, thank you, Commissioner, appreciate that. Because, you know, one of my concerns is, look, the FEMA flood program encourages people to build where they should not build, let's face it. And I believe that land use planning in California does the same, and therefore it puts you as a commissioner in direct conflict because you're trying to protect consumers, we got that, but you're not really facilitating insurers being paid for risk, and it's those risk prices that then inform mayors and counties. You shouldn't approve that development, or you should develop mitigation in this particular high-risk area. Mr. Frazier, in your testimony, you say an insurer is not permitted to seek a higher premium level, even if it would like to go into higher risk areas. Under regulations, that insurer must first sustain high losses, then request permission for a higher statewide premium level. That doesn't seem like a reasonable expectations. It encourages insurers to withdraw from high-risk areas. Is that what you're seeing happen in California, Mr. Frazier?
Yes, sir. In the highest risk areas, prior to 2017, the FAIR plan, which is the residual market, had about a resting point of about 125,000 people or homes regularly. That number has gone up to about 270,000. So clearly the shock in the system from the mega fires of 2017 and 2018 have had an impact. And so companies certainly looked at their rules for risk selection and compared it to the prices to figure out if they matched. And there's been some pullback, but obviously the vast majority of policies have been and are renewed. But certainly a system that doesn't allow statewide premiums to be looked at.
Thank you. I'll move on real quickly there, Mr. Chairman, and submit that writing, your answer in writing. Mr. Wright, you've got great experience as the former Deputy Associate Administrator for the National Flood Program. And so you know exactly what I'm talking about on the challenges of reforming our flood program on its 17th extension under the continuing resolution. So would you submit for writing for me what your views are of having a national wildfire insurance program? Is that good for taxpayers and good for insured people?
I will submit a fuller answer in writing. It is a bad idea.
Thanks. Yield back.
Ranking member yields back. I just have to say I agree with the ranking member on allowing people to move where they should not live. I now recognize the distinguished gentleman from Texas, Mr. Green. You're now
Thank-
recognized for 5 minutes.
Thank you, Mr. Chairman. Thank the witnesses for appearing. I'm interested in the area that the chairman has introduced, and that is mitigation. With reference to mitigation, do we have policies that require mitigation before issuance? This is a means by which homeowners can have an opportunity to improve their property if they make adjustments and also get insurance. So do we have policies that address it in this fashion? Anyone, please?
If I can share that the regulations that are hopefully about to go into effect in California that Commissioner Lara brought forth do provide that the homeowner gets to know what their risk score is, what number the insurer has put on their home, and then have the opportunity to know why they got that score, which I think is really important because people have just been getting the price signal. They've been getting these much higher prices and they've been getting dropped, but they don't know what, in many cases, when my organization surveys homeowners, when we say, did your insurer tell you what you could do to keep your policy? They'll say, no, they didn't. So again, I think, we're making some progress in that direction as a result of the regulations that are pending now in California.
Thank you. Anyone else?
And just to add,
Representative Green, Representative Green, it's also the case at the, frequently at the local or county level, you see some regulatory, that is to say the authorities have the ability to go house to house as relevant to say, for example, in let's say El Cerrito, California, to move up a street and tell each one of those homeowners, you need to work on your ignition zone and defensible space, or else you could be fined. So wholly apart from what the insurance carrier might be saying, there's also pressure at the local level.
just to quickly add, if I may, just again, the regulation will also do something that it hasn't done before, which is look at community-wide mitigation. And working with the insurance trade groups and consumer groups is also providing that communication about the community-wide risk reduction. Because if we bring down the risk for the entire community, we keep insurers writing in those communities, and consumers are able to have more insurance products that they can, the insurance companies can compete for and drive that cost down.
Yes, sir. If I may add, we appreciated very much the chance to work with the commissioner on these regulations. Think they will bring a lot more transparency so that people understand what they're being asked to do as part of this overall solution.
Mr. Chairman, I'm going to yield back because I know that the time is of the essence for you, so I'll yield back.
The gentleman yields back. It's time. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Chairman Cleaver. Mr. Frazier, at a September 8th meeting of the Senate Banking Committee, the National Association of Insurance Commissioners witness referred several times to the kinds of risks that are just too large and uncertain for private sector and state regulators to tackle. Are we anywhere near that now on fire insurance? Mr. Frazier?
I'm sorry, sir, I didn't hear your question.
At a September 8th hearing of the Senate Banking Committee, the National Association of Insurance Commissioners witness referred several times to the kinds of risks that are just too large and uncertain for private sector and state regulators to tackle. Are we anywhere near that now on fire insurance?
We do not believe so, sir. At this point, the private insurance market still functions in a robust fashion in California. We stand ready to work with policymakers and stakeholders to continue serving these communities. Obviously, we're in a time of transition because of how climate change has become manifest. But at this point, this is still a market, a situation that the private market can serve.
Okay, thank you. Can you please describe how state insurance commissioners are ensuring or will ensure that insurance carriers will give incentives to policyholders to mitigate wildfire risk and reduce premiums? Mr. Frazier, that's you again.
This is,
Sorry, I'm having a little bit of delay issues, sir.
Did somebody else start to weigh in on that?
Representative Posey, this is Commissioner Lara. That's exactly what the regulation is intended to do. We brought all the state agencies together so that we can all be operating with the same fire science with the insurance industry and consumer groups to give those incentives so that consumers know exactly what they need to do to protect themselves, their property, and their families, and then price the insurance accordingly so that people are paying for the risk of where they're living.
Thank you, Commissioner. Well, I know we're talking about wildfires today, but on a parallel and similar matter, let me ask you a question about the impacts of deferring approval of premium rate increases during a period of rampant inflation. It's my understanding you haven't approved an auto rate increase since April of 2020. And according to the U.S. Bureau of Labor Statistics, our 40-year high record inflation means that costs have increased 16% for nearly everybody over the past 2 years. If your department won't accept any rate increase filings, but costs have increased 16%, wouldn't that undermine the capital adequacy, solvency, and the ability to continue to enforce insurers out of the state, harming consumers? I mean, we don't like paying for gas in Florida when it was just, paying $4 a gallon for gas in Florida when it was $2 just a couple of years ago. And I know it's even worse in California because the all policies out there. But we're glad we can get it. $4 a gallon gasoline is better than no gasoline. So, like your opinion of that.
You're talking about private passenger auto rate filings?
Yes, sir.
Oh, okay. We are currently in reviewing the various passenger private auto filings, and we are putting it through our regulatory process to make sure that those rates are adequately fair, that they're not discriminatory, and they're moving currently through our process. What we are also looking at to making sure that the insurance companies that during the pandemic made so much profit that they are returning some of that because we knew that Californians were driving less. Therefore, the risk profile changed so that they were paying premiums that no longer reflected that risks. But we are moving as quickly as possible to make sure that we're reviewing these rate filings and we will be taking action in the future.
I'm glad to hear they're driving less out there during the pandemic because my trip out there, everywhere I went was bumper to bumper. Mr. Frazier, is there still room for mitigation incentives to substantially reduce the premiums in wildfire areas?
We believe so, sir, both at the parcel level and the community level. Obviously, the community level, it's a lot harder because field treatments can be controversial in communities and opposition can develop. And so while everyone wants safer communities, there's also the difficult on the ground conditions of implementation.
I get it. What role are state forest management plans playing in the current trends in fire insurance premiums?
We certainly look forward to the updating of our CAL FIRE maps. The state puts out hazard maps, and we're due for a refresh. It's been over a decade. So a lot of concern about the impacts these maps will have, but we do need the updating of these maps, and then from there, figuring out how we move together.
Thank you. Mr. Chairman, I see my time is about to expire, so I'll yield back.
Gentleman yields back. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes. I might, don't start his time yet. Votes have been called. We have one vote. But in respect of your time, we're going to try to continue with the hearing, and we'll have members come in and as we, after they vote, and I'll try to make sure somebody comes in to chair when I go to vote. Mr. Rose, you're now recognized for 5 minutes.
Thank you, Chair Cleaver and Ranking Member Hill, for holding the hearing on wildfire insurance. As many of you know, wildfires present a growing risk to life and property, mostly in western states. We know, however, Tennessee is no stranger to wildfires itself. In 2016, as I think most know, a deadly wildfire swept through the Smoky Mountains, burning over 16,000 acres and destroying 2,500 homes, which caused an estimated $2 billion in damages. Many of you know the area around Gatlinburg and the Smoky Mountains. So I appreciate the opportunity to continue to examine ways in which we can both respond to and mitigate risk associated with wildfires. Mr. Frazier, my first question is for you. Overly rigid local environmental and land use standards in places like California prevent homeowners from being able to take specific steps needed to make their homes more resistant to fire. Mr. Frazier, can you talk about the impact that environmental standards have on new construction and how this is having the ultimate effect of making homes less resistant to wildfire?
Yeah, it does seem like the pressing question in land use is that it's difficult to build in the urban core, and so you have to continue building.
We apologize, we're having,
To fuels.
We lost you for a second there, Mr. Frazier.
Hopefully I'm back. I was just saying it's much more difficult to build in the urban core in California, and so you have to build further out, and placing these more and more homes in closer proximity to fuel, and it certainly is making the situation more difficult. But that's why we do the work with IBHS and others, and these new regulations that the commissioner developed, I think, will help the situation.
Sure. And I'm curious, Mr. Frazier, if you could speak a little more on the question of the broad policies that California has in place with respect to forest management, and whether there is any recognition that more aggressive, long-term traditional forest management practices that need to be restored in order to deal with the threat of wildfires going forward.
Yes, there's no doubt there's been a shift just from providing funding for immediate response to fires to starting to look at pre-fire loss mitigation, and that includes fuels treatment. Obviously, in California, it's a difficult environment because you have the traditional conflicts between foresters and environmentalists. But certainly, things are improving. The governor has been quite committed to working with the legislature to make sure there's considerable new funding for fuels treatment in a way that just simply wasn't being discussed 5 or 10 years ago.
Sure. Switching gears a little, since we have Commissioner Lara, I would like to touch on some issues that are broader than wildfire insurance, because California is such a large market for insurance products, and the policy decisions you're making can have ripple effects across the entire industry. Commissioner Lara, California's Proposition 103 requires that prior approval of California's Department of Insurance before property and casualty companies can implement insurance rates. Isn't it true you have, over the last 2.5 years, withheld approval of rate increases for all pending auto rate filings because of your view that insurers provided inadequate COVID premium refunds to customers?
Thank you, Representative Rose. As I said earlier, we are those rate filings are currently within the department. They're being reviewed under Prop 103 to ensure that they're fair, they're adequate, and they're not discriminatory. And yes, I'm proud of the fact that in California, we mandated rebates back to California drivers who were driving less during the pandemic. $2.4 billion have been returned to California motorists because, again, the risk profile changed during that pandemic. And so, therefore, consumers were paying for a policy that no longer reflected that risk because we asked them to stay home. So we are moving now, understanding that the pandemic is moving towards the end, and we are now in the process of reviewing those rate filings for the private passenger auto.
So why have insurance companies like Geico, Progressive, and Allstate begun to leave California's insurance market?
Representative Rose, they have not left the market. They left the brick and mortar. They are still doing business through their online businesses, and I feel that this is going to be a move as more companies move towards online services as they modernize their business practices, but they have not left the California insurance market.
All right, I see my time's expired. I yield back.
The gentleman yields back. The chair now recognizes the notable chair of the full committee, Ms. Waters.
Thank you very much, Mr. Cleaver. Commissioner Lara, when buying a home, the only current federal requirement surrounding natural hazard risk is FEMA's flood zone determination requirement. However, our home state of California has gone above and beyond improving risk disclosures to mandate the inclusion of wildfire risk and other natural hazards. Given the current state of the wildfire insurance market, along with the increasing frequency and intensity of wildfires, would you recommend that similar disclosure mechanisms be enacted across the country for those purchasing a new home? If so, do you think it should be done on a state-by-state basis so that state insurance commissioners are able to customize their disclosure forms to best encompass the specific risk that home buyers in that state need to be aware of?
Thank you, Congresswoman Waters. I believe that in order for us to really protect and ensure that consumers know exactly the risks they're getting into, disclosure is critical. People need to understand the risk, and that disclosure becomes critical. It is true that as insurance commissioners, we have to adapt to the individual needs and topographies and requirements within the individual states. So I would say it's important for us to ensure that we respect the jurisdiction of the individual states. But at the end of the day, we know that consumers need to have this information before they purchase a home, and understand the type of insurance they're going to need. As you know, one of the biggest issues we're facing nationally is the issue of consumers being underinsured, especially during these wildfires, floods, or climatic events in which people feel that they are properly insured, but after realizing that they're not, they cannot rebuild to the standard that they were expecting to. So transparency is critical so that they understand not only their coverage limits, but understand the risk that they're undertaking.
Thank you very much. Ms. Bach, climate-related disasters such as wildfires are posing an increasing threat to the United States mortgage market as more people are living in disaster-prone areas. For instance, more than 46 million homes with an estimated value of $1.3 trillion are now at risk from the impacts of wildfire. Given the systemic risk that wildfires and other natural disasters pose to the mortgage market, what role can federal agencies, such as the Federal Housing Administration, USDA, and the Federal Housing Finance Agency play in setting standards for homeowners' insurance coverage?
Thank you so much, Chairwoman. It's an honor to be with you. And I just saw your star in St. Louis, and I was so proud. So, you know, first of all, California has passed a disclosure requirement now that realtors have to use if a home that's being purchased is in a high-risk wildfire area. So that's already in place. And as far as the lending sector, the Fannie Mae guidelines that Congress has set do require homes that are backed, that are subject to a federally backed mortgage, have replacement value insurance on that home. So you've got that in place. But I think that it's got to be enforced, that, you know, insurers are, of course, doing all kinds of nipping and tucking of coverage to try to balance their books in the face of climate change. So maintaining the basic standard that's already in the law is important for homes to have replacement value coverage. That said, you know, we are, Fannie Mae, they are very much engaging in our efforts to promote and facilitate risk reduction in the wildfire context. So I think, you know, we're on the right trail, but more consumer education, of course, at a very granular level. What can you do at your home to reduce your risk it's developing fast. There's a lot of tech companies now, Zesty AI, Betterview, that are developing tools, mostly for insurers. What we need is tools for property owners so they can quickly put their address in and see what their risks are.
Thank you very much, Mr. Chairman. I just want to tell you, in California, where we also need earthquake insurance, we're going to be insurance poor. It's going to cost more than our mortgages, so I don't know what to say about that, but it's going to be very costly. Thank you. I yield back.
We thank the chairwoman for making it here in time to raise issues with our illustrious witnesses. I'd like to thank you very much for coming to the hearing today or being a part of the hearing. We apologize for any technical difficulties that I almost said that may have happened, but that did in fact happen. We apologize for that, and we would also like to say to our members that you have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. And we're requesting that the witnesses please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to email addresses provided by your office. The hearing is now adjourned.